Good afternoon and happy Friday, dividend growth stock investors. It is Colby, the DGI Crab, coming to you at a little bit after 3 o'clock Central Time. Markets are closed for a long 3-day Labor Day weekend. Happy Labor Day to you all. I hope that you have some good times with friends and family. Enjoy the extra time off of work if you're getting it. And you've got a little bit of time, a little extra time this weekend to think and strategize as to what you're going to do with your investment dollars for next week, where we're only going to have 4 days to purchase our stocks. This is my favorite video to record of the week, where we're going to go through each of the 4 tiers to see where the value lies. If you're new to the channel, this channel focuses on just 60 very high quality dividend growth stocks with long track records of increasing their dividends year over year and generating growing passive income for their shareholders. I've broken them down into 4 separate tiers that are based on the age of the investor. This video should not be construed as investment advice, as I am not a licensed professional financial advisor. These are just the opinions and the strategy of this one crab. Hopefully this will give you some ideas and some food for thought as you are planning your investment journey. So let's jump into the aforementioned spreadsheet. So here we are. If this is your first time here, what we're looking at is the valuation tab, which is going to show us how far off the current day yield is from the 4-year average. That's the primary metric that I am utilizing to purchase these stocks. As I said, they've all got a long track record of increasing their dividends, and these are all what I would consider blue chip companies. Almost all are large cap companies. All but 4 are S&P 500 companies. So these are sleep well at night stocks that will generate you passive income. Tier 1 is for the 18 to 30-year-old investor, where we are trying to attain a dividend yield that we are expecting to increase year over year, hopefully about 12% cumulatively for the group. If we can get even higher than that, that's even better. But they are lower yielding stocks at the purchase point. You're probably going to be purchasing most of these in the ones, but that's okay. If you're young, this number over here is more important. You want that growth rate, so your dividend income will have plenty of time to compound. Once again, Nike remains at the top of the list. That 4-year average yield is very gradually creeping up the longer Nike stays down, but Nike has had this nice rally from the epic crash that they had back in June. They fell all the way down into the low 70s. We're back up to the $83 range, which is certainly nice, but Nike is still the most undervalued stock by my metrics of the entire 60 stock list that I'm focusing on here. So this is one I'm going to continue to buy. Nordson at 30% undervalued is still in that green category. If we're in the green category, we've got at least 30% above the 4-year average. Now, I don't buy anything unless it is a minimum 20% above the 4-year average. 30% it's squarely in my buy zone, and Nordson still is after that 14% dividend increase a little over a week ago. Nordson's dividend yield is sitting in a nice place, 1.22%. 4-year average of less than 1%, just 0.93. So we're getting a rapid growing dividend payer here, 30% higher than the 4-year starting yield. That is good enough for me. Everything else here, we're just holding. I don't sell these stocks. I just buy them, let dividend reinvestment do the heavy lifting for me, and I just hold for the long term and let them generate that passive income. Let's move into the tier 2 category. So for our tier 2 investors, starting yield is going to be a little bit higher. So you're probably going to get stuff more in the 2 to 2.5% range. Most of the time, we're looking for a dividend annual growth rate in the high single digits, so minimum 7%. Hopefully, we can average even higher than that. Still looking at the 2 stocks from last week. Hershey and Target are in the buy zone. Well, Target was actually just out of the buy zone last week. They've crushed earnings a week ago. The price shot up, and it's It's corrected down just a little bit, but Target is still a fine value here, 30% undervalued at 153 a share. Hershey yielding 284 and Target 292. So we're getting dividend yields of just shy of 3%. And these are stocks that generally are increasing their dividends at a pretty rapid clip. You'll see in 2023, Hershey's dividend increase was 15%. Target's was 10.1. So, and if you compare them to the starting yields here, Hershey usually doesn't even yield as high as 2%. So getting it at nearly 3 continues to be a great deal for me. This is the one that I personally am focusing the hardest on right now with my investment dollars, as I am in the tier 2 category myself here for about another year and a few months. So I'm definitely taking advantage of these cheap Hershey prices. Tier 3, still looking at Hormel and Archer Daniels Midland as our two main buys here. Our Tier 3 category is going to be starting yields in the 3% range most of the time, at least cumulatively. And our annual growth rate, not quite as high as the other two, but still really nice and solid. 5, 6, maybe even 7% is what we're trying to accomplish here. As we start nearing that retirement age, we're adding yield a little bit quicker here, but not being totally unconcerned with growth. T. Rowe Price, I've been mentioning this for the last few weeks. T. Rowe Price's stock price has been just sliding down. It's creeping into the buy zone. It's not there just yet. So I'm being patient here. I don't want to add anything too early. Listen, buying individual stocks is inherently more risky than buying ETFs. Obviously, I like to buy single stocks, but if I'm going to put my hard-earned dollars into them, I've got to get a deal. They've got to be trading at a discount. T. Rowe Price has moved past Medtronic on the list into that number 3 position. We've been buying Medtronic quite a bit since the start of the channel in June, but now that it's up here in the high 80s, I'm okay to just sit back and wait. So that's what we're looking at with the Tier 3s, Hormel and ADM. Tier 4, still nothing in that buy zone. Tier 4 investors. Eventually, we're going to get there. You know, I went back and looked at it. Over the past 2 years, absolutely positively, each and every one of these 10 stocks has been in that 20% undervalued or better. It's just they're not there right now. So congratulations if you've purchased some or all of these stocks when they were looking really undervalued. I remember Altria Group just earlier this year was trading for under $40 a share. Its yield at one point hit 10%, which was just fantastic. That was a great time to purchase Altria stock. But, you know, right now, none of this stuff looks like a good purchase as far as getting a good value with single stocks. Verizon, probably the best of the bunch right now. You can get a nice starting yield at 6.37%. It is qualified tax advantage dividend income that pretty regularly increases by about 2% a year, but I just need to get a better deal than this. The Tier 4, these 54 and older investors, this group of stocks, probably on average, you're looking at minimum 5% starting yield, hopefully higher than that. A lot of them like Main Street Capital, Verizon, Ares Capital, the aforementioned Altria Group are going to yield even higher than that, especially when you're getting them at a discount. And we haven't discounted growth here at all. We still want to get better than 3% annual dividend growth to make sure that we're beating inflation or at least matching it in a quote unquote normal year. But yeah, for right now, I'm just holding and dripping and not adding any more money to these positions personally. I always swing by this top 10 tab here. These are my top 10 favorite stocks. If I only were to invest in 6 or 10 individual stocks, these are the ones that I would narrow my focus down to. I forgot to sort those, so I've got to adjust that there. These are all spread out, so these all are contained in either tier 1, 2, or tier 3. So we're not looking at a new set of stocks here, but if you wanted to, take a closer look at what I think my 10 favorite ones are, that's it. These I don't even wait for them to get into the green at 30% undervalued, because most of them seldom even get there. If they get that 20% mark, I'm jumping all in on them and buying them. I would even prioritize them over some of the other ones because they're just that strong for me. Pepsi's getting there. Not there though, just 14% undervalued. I wouldn't fault you if you were trickling some money into Pepsi right now, but again, I'm going to be really patient with these individual companies. So the strategy and what it would probably look like here in my case. Now, this is where we were last week. I decided to keep last week's numbers on here just so you could kind of see how I would adjust this from week to week. Now, up here is would be ETFs, and down here would be single stocks. My belief or recommendation, however you want to look at it, is that when you're investing, you put at least half of your money into ETFs, so you get automatic diversification, and you're not trying to necessarily time the market with those. Stock markets nearing or at all-time highs doesn't mean that we're going to just stop buying stocks. It just means that we'll just dollar cost average into ETFs. Tier 1 folks, S&P 500, small cap, dividend growth, and international. This is about the right breakdown here for me. Tier 2, it's dividend growth, S&P 500, and small caps go down a little bit. International, 5% consistently across the board. The Tier 3 folks, I like higher yielding dividend growth ETFs at this point. So VYM, SCHD, DHS, you could split your money evenly among those three. You could put it all on one if you liked SCHD or VYM or DHS just the best, and that's the one that you wanted to focus on. That's fine as well. And then the tier 4 folks have a lot of different ETFs, because most of this stuff I don't think is a great idea to invest in until you've hit that point where you're well into your 50s and you're trying to accumulate yield quickly. So you can add some stuff like high yield bonds, preferred shares, MLPs, covered call ETFs. Devo and Jeppy, I still think are the top two. I am going to be doing a video on SPYI in the very near future, so keep an eye out on that. I'm warming up to that one. I'm warming up to it. I'm not quite there yet, but it's looking pretty interesting. So last week, this is what we were looking at for stocks with that other 50%. I was thinking 30% and 20% Nike Nordson. That still looks just fine to me. Now over here, we had Hershey and Nike, Hershey 40, Nike 10. If a stock in any of the tiers is 50% undervalued or more, I think it's totally appropriate for any of the tiers to move out of their lane, so to speak, and jump over and grab some of that as well. Now, I wouldn't prioritize Nike over Target at this point, so I'd probably go Target at 10. Maybe I would take Hershey down to 30, right? And then do my 10% over here into Nike, and that would be my 50% in tier 2. And this is exactly what I did with my single stocks for the week. It was 30% of the money to Hershey, 10 to Target, 10 to Nike. Simple as that. I still think the same breakdown applies here for tier 3. You can go 25 Hormel, 20 Archer Daniels Midland, and a little 5% dip into Nike. And again, tier 4 folks, just double down on those ETFs. So here's 50% of your investment dollars. I'd double down on everything but the international one. I'd keep the international one at 5% for consistency, but it'd be 20, 20, 10, 10, 10, 10, 10. And then you've got a wild card for your other 5% left over. You can throw that really wherever the hell you want. Why not? You're getting a lot of nice starting yield, monthly paying stuff here. So any of the other stocks that are in the buy zone, throw your 5% at it. It could be Nike if you're not really worried about the low starting yield. It could be, maybe Hormel or ADM in the next tier down, whatever you think is best at that point. All right, everybody, that's it. Links to the 4 tiers videos in the description below so you can see exactly how I put this list of 60 together. Have a happy Labor Day weekend, everyone. Go get that passive income.